Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial mysteries of the corporate world. And today we've got a real puzzle box with Maywood Acquisition Corp's latest report. It seems like they're hoping to get their acquisition sorted out soon. We're diving into Maywood Acquisition Corp's quarterly report, or 10Q, for the period ending June 30, 2025. If you're new here, we break down these official documents to find out what's really going on behind the corporate jargon. Make sure you're subscribed and join our Discord community, linked in the description below for more insights like this. Let's jump straight into the heart of the matter, the balance sheet. This is like a snapshot of what the company owns, what it owes, and what's left for the owners on that specific day, June 30, 2025. Right off the bat, we see total assets standing at a little over $88 million. That sounds like a lot of money, but we need to see where it's all going. Now, looking at their liabilities, or what they owe, it's about $3.9 million. This includes things like accounts payable, money owed to others, and importantly, a deferred underwriting fee of $3.45 million. Think of this deferred fee as money promised to the investment banks that help them go public, but it's only paid if they actually pull off their big business deal. Here's a really interesting point. They have over 8.6 million shares that can be redeemed, basically meaning the shareholders can ask for their money back, like cashing in a ticket. This is a big chunk of their company, over $87 million worth. And it's crucial to remember that this money is held in a trust account, meant for a future acquisition. It's not truly available for day-to-day operations. This next line is a bit of a head scratcher if you're not used to these reports. Total shareholders deficit comes in at a negative $3.4 million. This means that the liabilities and the money owed to those redeemable shareholders are more than the company's own equity. For regular companies, this might be a red flag, but for a special purpose acquisition company or SPAC like Maywood, it's a bit different. They're essentially holding money for a future deal, so this deficit reflects that structure. Now, let's switch gears and look at how the company performed financially over a period of time, specifically the statements of operations. This shows their income and expenses. For the 6 months ending June 30, 2025, they reported a healthy sum of over $908,000 in other income. This income mainly comes from the interest earned on the money they've parked in that trust account. It's like getting a small return on the money they're holding onto. On the flip side, they had formation and operating costs totaling around $87,000. These are the costs of running the company itself, like setting things up and general administration, before they've even found a business to merge with. Even with those operating costs, they ended up with a net income of over $861,000 for the 3 months, and a larger net income of over $1.2 million for the 6-month period. This is mostly thanks to the interest they earned on their trust account funds. Remember, they aren't making money from selling products or services yet. It's also important to note the share counts. For the 3 months, they averaged over 8.6 million Class A redeemable shares. For the 6 months, that average drops to about 6.4 million. This difference is due to when shares were issued during the period. Based on these numbers, their earnings per share for Class A redeemable shares is 7 cents for the quarter and 13 cents for the 6 months. Again, this is driven by the interest income. Let's quickly glance at the statement of changes in shareholders' deficit. This table shows how the equity section of the balance sheet has changed. We see the impact of selling private placement units, which brought in over $2.6 million in additional paid-in capital. This is money from investors who bought shares directly, not through the main public offering. And here's that redeemable share adjustment again, showing nearly $10 million in changes to their value. Remember how we talked about those shares being outside permanent equity? This line reflects the accounting for that, adjusting their value as it relates to that potential buyback. Now for the statement of cash flows, this is crucial because it tracks actual cash moving in and out of the company, which is the lifeblood of any business. We start with net income, about $1.2 million for the 6 months, but then the adjustments begin. The first major adjustment is a negative $1.3 million for income earned on investments in the trust account. This is an adjustment to show that while it's income, it's not cash they can actually spend freely. Then we see a massive outflow of nearly $86.3 million labeled cash deposited in trust account. This confirms all that money from the IPO and private placements is indeed locked away in that trust. On the financing side, we see the huge inflow from the IPO, $86.25 million and another $500,000 from a sponsor loan. However, they also paid out about $2.4 million in offering costs, which includes fees to the banks and expenses related to getting the IPO done. All these movements result in a net increase in cash for the period of about $496,000. This is the cash they have available outside of the trust account to operate. The notes to the financial statements are where the real details live, explaining all the numbers we've just seen. This confirms what we already know. They are a SPAC formed to find a business to acquire. No operations yet. This is a critical piece of information for any SPAC. They have a strict deadline, 15 months, which can be extended to 18 months to find a business and merge with it. If they don't, the company essentially dissolves and the money in the trust account goes back to the shareholders. The trust account is their bank account for IPO proceeds. It's a secure place where the money sits until they either make a deal or have to return it. They also provide details on how they value certain assets using different levels of inputs. For Maywood, their cash and trust account funds are level 1 assets, meaning they're valued at the quoted prices in active markets, which in this case is their face value. This section is management's discussion and analysis. It's management's chance to talk directly about their company's financial health and what's expected. This clearly states how they plan to use the operational cash they have. It's all about finding that target business. Here's a section that always gets attention: going concern consideration. Management acknowledges that if they don't find a business to merge with within their time frame, they'll have to liquidate. This concern does raise substantial doubt about their ability to continue as a going concern, meaning if they don't make a deal, they cease to exist. They reiterate their net income figures, showing that profit is driven by interest income on the trust account. It's a consistent theme. Money makes money even when it's just sitting there. They remind us about that deferred underwriting fee of $345 million. This is a significant cost that's contingent on a successful business combination, a cost that could be a hurdle if that deal doesn't happen. This part talks about their internal controls. For a newly public company, they are stating their disclosure controls and procedures are effective as of June 30, 2025. They're still a bit early to require full Sarbanes-Oxley internal control over financial reporting audits, being an emerging growth company. This detail goes back to their early days, explaining how the sponsor got their initial shares. It's a standard practice for SPAC sponsors to get a significant chunk of shares for a very low price in exchange for taking on the initial risk and cost. This lists all the accompanying documents. It's like the appendix of the report. And here we see certifications from their principal executive and financial officers, basically confirming that they've reviewed the report and believe it's accurate. Finally, the signatures. This is where the company's leadership officially signs off on the report. Here we see the signature of Zikong Wu, the Chief Executive Officer, Principal Executive Officer, and Principal Financial Officer, making it official. So what's the story here with Maywood Acquisition Corp? They're a blank check company, meaning their main goal is to find another business to merge with and take public. Right now, their operations consist of managing the money they raise from their IPO and private placements. They're earning interest on this money, which is why they're showing a profit, but it's crucial to remember this isn't from actual business activity. The biggest takeaway is their deadline. They have a limited time to find a suitable acquisition. If they don't, the money in trust gets returned to shareholders, the shareholder deficit, and the mention of substantial doubt about their ability to continue as a going concern are direct consequences of this SPAC structure. They essentially don't have a viable business until they complete their primary objective. The significant deferred underwriting fee also hangs over them, a cost that only gets paid if they succeed. Their direction heavily depends on their ability to strike a deal that's both attractive to them and acceptable to their shareholders. The shareholder deficit and the mention of substantial doubt about their ability to continue as a going concern are direct consequences of this SPAC structure. They essentially don't have a viable business until they complete their primary objective. The significant deferred underwriting fee also hangs over them, a cost that only gets paid if they succeed. Their direction heavily depends on their ability to strike a deal that's both attractive to them and acceptable to their shareholders. The risk is high, but so is the potential reward if they find the right merger target. That's our deep dive into Maywood Acquisition Corp's quarterly report. What do you think are their chances of finding a good acquisition? Let me know in the comments below. And if you found this breakdown helpful, please hit that like button and subscribe for more corporate analysis. Don't forget to join our Discord community. The link is in the description for more engaging discussions. Thanks for watching, and we'll see you in the next one.